It starts with a very ordinary American home. A couple opens Zillow again. They check the same homes they saved a few weeks ago. The prices did not collapse. The monthly payment did not improve. And somehow, even though everyone kept waiting for relief, the financing side just got worse again. That is the part many people miss. When mortgage rates rise, most Americans assume the reason must be something local. Maybe it is the federal. Maybe it is inflation data. Maybe it is the housing market itself. But this time, the pressure is bigger than housing. Because the chain now runs through war risk, oil risk, Treasury yields, and only then into the American mortgage market. So this is the real story. Why are mortgage rates rising again, just as spring housing demand should be improving? Why can a war thousands of miles away make it harder for an American family to buy a house in Phoenix, Atlanta, Dallas, or Tampa? And why does this matter even for people who are not planning to move this year? By the end of this video, you will see that the housing pain is not just about home prices anymore. It is about how a geopolitical shock can keep long-term borrowing costs elevated, delay relief, and turn the American housing market into another transmission channel for global instability. This matters right now because housing is one of the most emotionally important parts of the U.S. economy. People can delay buying stocks. They can postpone a vacation. They can cut restaurant spending. But housing sits much deeper in family planning. It shapes where people live, how long they rent, whether they feel financially secure enough to have children, whether they keep commuting from far away, whether they feel like the American middle-class path is still open to them. And the timing is brutal. Spring is usually when the housing market gets its best chance to recover. More listings come out. More families shop seriously. More sellers test the market. But the latest jump in mortgage rates is landing right into that window, which means the cost shock hits at the exact moment when activity should have been gaining momentum. That is why this is not a niche finance story. This is a household affordability story, a confidence story, a mobility story, and increasingly a political story too. Because when mortgage rates move higher again after months of public hope for lower borrowing costs, people stop hearing temporary volatility. What they hear instead is something much more personal. Maybe relief is not coming when we thought it would. What is actually happening is not complicated once you strip away the noise. Mortgage rates are rising again because long-term market rates are staying elevated, and long-term market rates are staying elevated because the market is repricing inflation risk and Fed risk after the Iran war pushed oil sharply higher. That is the mechanism in plain English. The mortgage market does not wait for a family's budget. It does not wait for Washington's messaging. It does not wait for buyers to feel ready. It reacts to the bond market. And the bond market has been forced to rethink the idea that rates were simply heading lower from here. Since the Iran war began, oil prices have surged, inflation concerns have picked up again, and Treasury markets have become more volatile. The energy shock has become harder to dismiss. Once oil surges, the market starts asking a new question. Not when does the Fed cut, but can the Fed really cut if energy inflation is coming back through the front door? That shift matters because the housing market had been leaning on the hope that lower rates were only a matter of time. Now that hope looks shakier. So let's map the chain clearly. First, war risk becomes oil risk. The Iran conflict is not just another distant geopolitical headline. It directly matters to global energy markets because traders immediately price the possibility of disrupted supply, shipping risk, and higher insurance and transport costs around key routes. Second, oil risk becomes inflation risk. Higher oil does not stay inside the energy sector. It moves into gasoline, diesel, freight, air travel, distribution, local business costs, and eventually the broader inflation psychology of the economy. Even before every CPI release fully reflects the move, households feel it, businesses feel it, and markets feel it. Third, inflation risk becomes Treasury yield pressure. If investors believe inflation may stay higher for longer, they demand more compensation to hold long-term bonds. That means higher yields, especially when uncertainty is high and the path of monetary policy gets murkier. This is where a lot of people get confused. They assume war should automatically push investors into treasuries and therefore lower yields. Sometimes that happens. But when the war is also an inflation shock, the safe haven effect can get offset by the fear that the Fed will have less room to ease. Fourth, Treasury yield pressure becomes mortgage rate pressure. Mortgage rates do not mechanically equal the Fed funds rate. They are much more tightly linked to long-term yields, especially the 10-year Treasury, plus mortgage market spreads and investor risk pricing. So when the 10-year yield stays elevated or rises because inflation fears revive, the 30-year mortgage rate usually does not get the relief people were expecting. And that is exactly what happened here. Fifth, higher mortgage rates become housing pain. That pain shows up in more than one place. The first hit is payment shock. A buyer who could barely qualify at one rate can suddenly fall out of range at a higher one. The second hit is confidence shock. Even buyers who technically still qualify may step back because the direction feels wrong. They stop asking, "Can we stretch?" and start asking, "What if rates are still high 3 months from now?" The third hit is market freeze. Sellers do not want to cut enough. Buyers do not want to overpay at high rates. People who locked in low mortgages in prior years still do not want to move. So inventory, affordability, and transaction volume keep fighting each other in a strained system rather than resolving cleanly. That is the full map. Iran war pressure becomes oil pressure. Oil pressure becomes inflation pressure. Inflation pressure becomes Treasury pressure. Treasury pressure becomes mortgage pressure. Mortgage pressure becomes housing pain across America. For regular Americans, the first consequence is simple. Monthly payments stay ugly. And in housing, that matters more than almost anything else. Many buyers do not shop based on the sticker price of the home. They shop based on what the monthly payment does to their life. Can they still save? Can they handle childcare? Can they survive a car repair? Can they carry student debt and a mortgage at the same time? When mortgage rates rise again, those questions become harder all at once. The second consequence is that renting pressure can last longer. If would-be buyers stay stuck on the sidelines because ownership costs remain too high, they stay in the rental market longer. That keeps broader household mobility under pressure and delays the normal flow from renting into owning. The third consequence is regional. In fast-growth markets where affordability was already stretched, another rate shock hits especially hard. Not because people suddenly stop needing homes, but because the financing math becomes even less forgiving. The fourth consequence is psychological. When families see oil jump, gas get more expensive, grocery and delivery costs feel less stable, and mortgage rates climb at the same time, the problem stops feeling sector-specific. It starts to feel systemic. That changes behavior. People postpone moving, postpone upgrading, postpone renovations, postpone furniture purchases, postpone risk. And when enough households do that at once, housing weakness stops being just a real estate issue. It starts feeding into the broader consumer economy. Now, there's an important counterargument. Some people will say this is being overstated. They will argue that the U.S. is more energy resilient than it used to be. That domestic production gives America more protection. That if inflation cools again, mortgage rates could still come back down. And that a short war shock does not necessarily mean a long housing freeze. There is truth in that. The U.S. is not the same economy it was in older oil crises. And not every jump in oil automatically becomes a lasting inflation spiral. But the common misread is thinking that because the U.S. is more resilient, the housing market is therefore safe. That does not follow. Housing does not need a full-blown national crisis to suffer. It only needs borrowing costs to stay painfully high for longer than households expected. And that is exactly why this moment matters. The damage does not have to come from a collapse in home prices. It can come from a slower, quieter squeeze, fewer transactions, less mobility, more payment stress, more renter frustration, and a spring market that never fully regains momentum. That kind of pain is less dramatic than a crash. But for regular Americans, it is often more immediate. So what happens next depends on three things. First, oil. If the conflict de-escalates and supply fears ease, oil could pull back, inflation anxiety could cool, and Treasury yields could stabilize. That would give mortgage rates at least a chance to stop climbing. Second, the bond market. If the 10-year Treasury remains elevated because investors think inflation will stay sticky or the Fed will stay cautious, then mortgage relief may remain limited even without another fresh energy spike. Third, confidence. Because housing is not just math, it is expectations. If buyers believe rates have peaked and stability is returning, some activity can come back even before rates fall dramatically. But if people think every geopolitical headline can push affordability backward again, caution will dominate the spring and maybe beyond. So the real verdict is this. Mortgage rates are rising again, not because housing suddenly broke on its own, but because housing is being hit by a much larger chain reaction. A war shock pushed oil higher. Oil pushed inflation fears higher. Inflation fears pushed Treasury yields higher. And Treasury yields pushed mortgage pain back into the everyday American economy. That is why this story matters. Because in America, housing is where global stress becomes personal. Not in the language of diplomats, not in the language of bond traders, but in the language families understand immediately. The monthly payment, the move they delay, the house they can no longer afford, and the relief that keeps getting pushed further away.